is really out of line. UK is out of line, but I'm sure that one, I think that one can be worked out. But the European Union it's an atrocity, what they've done.
Prime Minister Starmer wants to close the relationship with the EU. So
well, Prime Minister Starmer has been very nice. We've had a couple of meetings. We've had numerous phone calls. We're getting along very well. And we'll see whether or not we can balance out our budget. With the European Union, it's $350 billion deficit. So obviously something's going to take place there.
Follow up on this, for the European Union, what's your timeline? And are you thinking along the line 25%? 10%?
With who? With who?
The EU, how much?
I wouldn't say there's a timeline, but it's going to be pretty soon. No, I'm not concerned. We may have short-term a little pain, and people understand that. But long-term, the United States has been ripped off by virtually every country in the world. We have deficits with almost every country. Not every country, but almost. And we're going to change it. It's been unfair. That's why we owe $36 trillion. We have deficits with everybody. We help everybody. We've been helping everybody for years. And to be honest, I don't think they appreciate it. So we're going to change that. We're going to change it fast. We're going to make America great again. We have to focus on our country. We have tremendous potential if properly used, and we have to focus on our country. Tremendous deficits with China, tremendous deficits with the European Union, tremendous deficits with Mexico and Canada. And why? What's the purpose of that? Why would we have deficits? And you look at if you look at pharmaceuticals and drugs, if you look at various products, it's much cheaper in other countries. We're not going to allow that much longer. We're not going to take it.
Mr. President, USAID, or what's going on there?
Well, it's been run by a bunch of radical lunatics, and we're getting them out. USAID, run by radical lunatics, and we're getting them out, and then we'll make a decision.
Mr. President, have you spoken with anyone from Canada or from Mexico since you appointed?
I've spoken with people from Canada, I've spoken with people from Mexico, and I've spoken to a lot of other people too.
Prime Minister Trudeau or?
I'm speaking with Prime Minister Trudeau tomorrow morning, and I'm also speaking with Mexico tomorrow morning. And I don't expect anything very dramatic. We put tariffs on. They owe us a lot of money, and I'm sure they're going to pay.
Would you send troops to take the Canal of Panama?
About what?
Panama, the Canal of Panama. Would you send U.S. troops?
I don't think troops will be necessary in Panama. What Panama has done is terrible for national security for this part of the world. And, 70% of the signage on the Panama Canal was written in Chinese. That's not right. So it wasn't meant for China. It should have never been made. The deal was a ridiculous deal. We lost 38,000 people building the Panama Canal, one of the great wonders of the world. 38. It was the most expensive project ever built by this country, if you take it forward. The most expensive project ever built. We lost 38,000. And what happens? China owns it all of a sudden? It's not going to happen. We're not going to let that happen. We have national security concerns, and they wouldn't let it happen either.
Mr. President, what does Canada and Mexico need to do for you to lift the tariffs? What are specifically you want?
That have to balance out their trade, number one. That we've got to stop people from pouring into our country, and we've stopped it. They haven't stopped it. We've stopped it. They have to stop people from pouring in, and we have to stop fentanyl, and that includes China. Fentanyl has killed this year at least 200,000 people. It's pouring in from China through Mexico and Canada, and they've got to stop it. And if they don't stop it, the tariffs are going to get worse, a lot worse.
Mr. President, you're going to the border.
All right, that was President Trump there, just speaking at Joint Base Andrews in Maryland, touching upon really a wide range of topics, including these tariffs that he announced over the weekend on Canada and Mexico and China. He's promised tariffs to come when it comes to the European Union. He says they will definitely happen without giving an indication of the timeline there. He also spoke about, some of the other concerns when it comes to the fentanyl trade and how, of course, that has been tied in with the decision to put in place these tariffs, as well as commenting on the Chinese presence when it comes to the Panama Canal. He says that he'll be speaking with Canadian Prime Minister Trudeau tomorrow morning. We have seen that reaction across markets, a pound extending the loss to 1% as these trade war concerns really mounting. Eurostoxx 50 futures falling almost 3% there. We're seeing the Aussie dollar, often seen, of course, as a proxy of trade and China risk, now sitting at the lowest since April 2020 against the dollar. Let's bring back in Enda Kara now, global economics correspondent who joins us now from Washington. And, and a lot to process there. One interesting thing I thought, he said that the Fed did the right thing by holding. So, it certainly draws a complicated picture for these central banks and policymakers amidst the start of yet another, trade war.
Well, it does. I mean, if you want to talk about the Fed angle on this, you have economists making the point that if you're putting duties on imports into the US, especially in the consumer space, then those prices will be passed along. We have some analysis out today saying a car could be $3,000 more expensive, for example. And then if you do have higher inflation off the back of these tariffs, then obviously that would complicate the story for the Fed bringing down interest rates. I think one of the interesting or one of the surprising observations people have had about the tariffs announced in Mexico and Canada and China is the breadth of them. There's no hint of a carve-out. It's not just input material or intermediate goods. It's food, especially food from Mexico. It's consumer goods. It's clothing. So obviously, it depends, of course, how much of the tariff is passed on by the importers, but nonetheless, it's clearly a talking point. The China tariff obviously is less. It's at 10% versus 25%. There's a case that that's maybe not as much as an immediate issue for the economy when you consider the exchange rate differentials there. But a lot of focus on what these tariffs might mean for growth and inflation. And of course, you just heard President Trump. He says it's all about balancing the trade books. It will drive investment and, of course, raise revenue for the government.
And what's interesting is that when it comes to the economic impact, of course, expectations are so important, right? Just talking about inflation could actually change consumer behavior. Are we starting to see this in terms of how Americans are pricing in the next few months, as we're now seeing tariffs on a broad series of goods, not to mention, of course, energy imports, which are so important for Americans?
Yeah, well, the energy imports are being tariffed at 10%, so there's some relief there. But, social media, for example, tonight, people are tweeting the prices of avocados going up in their local store. That's one of the imports that comes out of Mexico. And, of course, the critics of this tariff policy would make the point that inflation still remains above the Fed's target, so you're threatening that price base by adding on more duties at a fairly sensitive time. The thing to remember is that this particular round of tariffs has been targeted at Mexico and Canada because of the fentanyl trade, because of immigration, illegal immigration. There had been a consideration that maybe the governments could come to an agreement on that. We haven't seen any prospect of that yet, and President Trump just then didn't hint at anything is likely near term. So we haven't yet got to the merchandise goods deficit part of this. That's the next part of this story. So by all indications are, providing these tariffs do go into effect on Tuesday morning, the indications are this could be the start of a very long, serious, protracted negotiation between the three governments.
We're currently seeing President Trump departing from the Joint Base Andrews as we continue to, of course, hear from President Trump and all of the tariffs that he's been talking about, especially when it comes to also cutting funding to South Africa and, of course, those tariffs that might be coming for Europe as well. And we are considering these as an opening tariff, gradual and targeted at the moment? Could they get worse? I mean, President Trump has talked about even 60% tariffs on China during the campaign trail.
Less targeted and less gradual, Sherry. I mean, he's making a point pretty quickly in terms of the breadth of goods and the level, provided it goes ahead. But there's no question that when it comes to China, 10% as an opening gambit is a long way from the levels the president has spoken about in the past, during the campaign trail. And of course, we know that the president has been consistently hawkish when it comes to the merchandise goods trade deficit with China. So the expectations are there will be some kind of thorny negotiations coming down the road at some point. And then you just heard his remarks before getting on the helicopter that the European Union is in his sights. He's warned about that before, so they're going to be coming down the track. So, in terms of an opening gambit for trade disputes or a trade war with many key trading partners around the world, clearly we are at the early stages of that. It's hard to see how this would be solved easily, given the gulf of the problems between all of these countries, and of course the risk of retaliation as well. And from key trading partners, and the US themselves have promised that they will retaliate. There's a clause in the executive order that came out over the weekend that if Mexico and Canada retaliate against these US tariffs, the US will retaliate back against that. So you're in a tit for tat, and when you're in that kind of a cycle, it takes a long time to really, it's easy to start it, but it takes a long time to really unwind it. So, it's pretty hawkish, it's pretty serious messaging and decision making from the new president. And I think all the signals are that there will be considerable focus on trade negotiations with key trading partners, I think, at least in the early to medium term of this administration.
And the tit for tat this time comes at a time when the Chinese economy is a whole lot more vulnerable than it was back in 2018, right? Do you see there being more limited, weapons that Beijing can reach for, even if perhaps that 10%, is a pretty gradual start to proceedings?
Yeah, the China story has changed a bit since the last trade war, because remember, the pandemic, of course, had a dramatic impact on supply chains, on perceptions in terms of doing business with China. Investment and production has shifted, or at least, hasn't gone to China whereas once it would have. And then, of course, you've had the Russian invasion of Ukraine, which has also put China in the geopolitical crosshairs. So there is a bit of a different backstory to that, no doubt about it. And China, of course, on their side have diversified. I mean, they've been buying more farming produce from Brazil, for example, cutting their reliance on American farmers. But the president and people around him have, and in fact it's in the executive orders that they signed, have made the point that the initial trade deal with China hasn't necessarily been honoured. They're going to examine that and see have China kept up with the purchasing promises that they made back then. So there's an April 1 deadline for that. So there will be expected to be more news on the China front. And China, you've got a strong US economy, you've got a weak China economy at the moment, given the advantage to the US, a lot of observers would say, but China can respond in their own way. They can make it awkward for US companies to do business in China. They can make it awkward for US personnel to operate in China if they want to. And of course, they can trim or put whatever tariffs on trade to do with the US from their side as well. So there's a bit of a two-way in it, but there's no doubt in terms of a headline look at this that starting out, the US is considered to have a bit of a stronger hand of cards in this when it comes to the expected trade dispute with China.
Bloomberg Global Economics correspondent Enda Karan there from Washington. We did have that reiteration of that policy position and some of the really threatening of imminent tariffs to the European Union as well. We saw that immediate reaction really when it comes to European equity futures as well as trading in the euro and the pound. That reaction coming through the decline when it comes to Euro Stoxx 50 futures that we're seeing at the moment, the tumble of close to 3% at the moment. A range of currencies, the euro, the pound, including the Aussie dollar as well, as more of a risk proxy in this part of the world, are all sliding lower in response there. And it's interesting when it comes to that reaction in futures, we could see a pretty ugly open as we have seen in the cash session here in Asia. But of course, up until this point, we have seen European equities kind of trading almost with a sense of complacency, perhaps with this idea that, even after the announcement of expected tariffs on Canada, Mexico and China, those ones on the EU that are now still expected haven't come to fruition yet. So that dodging of of tariffs for now has been sustaining some sense of calm when it comes to European equities, but that looks like that may have come to an end in today's session, given the pretty ugly picture that we're seeing at the moment for Euro futures. Sherry.
Yeah, we're taking a look at really an ugly picture across the board right now as we head towards a Taiwan and Hong Kong market opens as well. Of course, we had already seen Chinese stocks that could potentially take a hit, like online retailers, Alibaba, chip makers, companies with Mexico exposure. We know that the tariffs include a broadside against e-commerce with apparent plans to kill a tariff exemption for packages worth less than $800. So those are some of the names that we'll be watching when Hong Kong trading gets underway. Take a look at TAIEX futures at the moment. They actually rose before the close about 0.5%, but we'll see what that means for other stocks like TSMC, for example, that could be one of the biggest hit when the markets open. Semiconductor makers in focus. Let's bring in Bloomberg's Apisha Vishnoi and Winnie Su for more analysis on what to watch when trading gets underway in these two markets. Let's start with you, Apisha. Hong Kong markets coming back from Lunar New Year holidays. What are some of the sectors that you'll be watching?
I think the sectors that you mentioned are pretty much on the money. I mean, online retailers would be the first thing that comes to mind. Names like Alibaba, PDD is not listed in HK, but those and those companies in relationship with those online retailers would be one that might get impacted the most. That would be followed by chips. Now, on chip side, Asia ex China, we might see some kind of repricing lower down. I mean, Taiwan is also just opening up and just about to factor in DeepSeek's jolt. But on China side, if these tariffs actually fan nationalism again, fan that whole point about China becoming self-sufficient in industrials and technology, then SMIC and the likes of Huahong might actually do better. Apart from that, Mexican exposure of all kinds of companies listed in Asia would also be on radar. Names like BYD were looking to open a plant there. There are some chip makers also that were looking to open plant there. Those investments now come into question. A lot of companies are earnings revenues based out of Mexico. China has a couple of auto companies as well which have revenues coming from Mexico. So that exposure would also be under threat. And Trump has just started this trade war, and we have seen him promising tariffs from a whole gamut of sectors. Right from pharmaceuticals to resources and whatnot. So the entire trade war sort of premium, or how markets were looking at it, that is getting priced in. So almost every sector would probably have sort of lower valuations to go ahead.
It's interesting, Abhishek, because with everything DeepSeek related last week, there's sort of one school of thought that maybe that development makes broader Chinese equities a bit more compelling.
Yeah, I mean, that's true. It does make Chinese equities compelling. But look, valuations so far have been factoring in that Trump would be a bit softer than what was generally expected in terms of tariffs, and probably Chinese valuations are cheap enough. But then, Trump has come in, followed up on his promise. He has been softer, but he has called in for 3 trade review reports by April 1. Now that just shows that he's looking for a lot more information to come on his desk before he actually decides what he has to do next. He has already employed a lot higher tariffs than what he had initially planned on Canada and Mexico. He's just beginning to negotiate with China, but it doesn't look like that this will become an upside trigger for China. It's a convoluted investment thesis. It's a thesis where China is cheap, but there are a lot of sectors at risk. So net, I think it's going to keep the valuations where they are.
And Winnie, of course, TSMC just escaped last week's sell-off because of DeepSeek, and they're coming back online today. And now we have these tariff threats as well.
Exactly, not the best start of the week after such a long holiday. But like you said, we had a very volatile week, and as we saw what happened to SK Hynix on Friday, down 10% after the Korean market reopened. That's kind of similar thing that we might be able to see today with TSMC and the Taiwanese stock stock market. The ADR's U.S. listed stocks were down about 13% on Monday when that news hit, but now it kind of had already recouped some of the losses and now just down about 5% because of some of the more positive news around ASML, around Advantest, some of the earnings showing that the AI demand is still there. So we might see a hit on semiconductors, especially TSMC, because it reopened after the stock market closed for so long. However, hopefully we won't see such a big hit just due to some of the more positive news throughout the week.
I suppose the question is also how much upside we could potentially see, right? Are there any stocks that you're watching in particular that could get the more of a sort of beneficial impact?
Well, in terms of beneficial impact, I don't think there are many sectors that I'd be watching out for, but definitely heavens are getting a bit today, right? From, currency markets to bonds, anywhere. So, you have to start thinking in that context. And, I was looking at our Morgan Stanley note, which was dated Feb 1, just when news flow on tariffs had started picking up. And that sort of reiterated the investment thesis that, our reporters have also been writing about, that, parts of ASEAN, which have been benefiting from supply chain diversification from China, parts of India, some sectors in India which are reasonably priced, they are better off. That's where there would be less downside. But look, it is the first salvo in trade war, we have seen Canada retaliating. We have seen, China promising to retaliate. So, it's an eye for an eye kind of scenario right now. So, net, the valuation would be lower for most sectors. But yeah, traditional havens and the thesis about ASEAN and India benefiting from supply chain diversification, that still stands, and that's where probably some money might get parked in.
Bloomberg's Abhishek Vishwa there and Winnie Su ahead of what is likely to be a pretty interesting market open across Greater China. We do have more ahead on the Asia trade. This is Bloomberg.
In case you missed it, from Bloomberg's coverage at Davos.
Could it spell disaster if there's fear in the markets? Or again, are there catalysts that you're watching out for?
It doesn't have to spell disaster, but what it probably will mean is that you have important trade-offs on the policy side, uncertainty and volatility in financial markets. But rates have gone up. We have $10 trillion in money market funds waiting to be deployed. So I think these things, create opportunities as well.
Nobody covers Davos like Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
India has given middle-class consumers $11.5 billion in tax relief in its latest budget in a bid to shore up its economy amid growing global risks. Let's get across to Bloomberg's Haslinda Amin in Mumbai.
Well, Heidi, that budget over the weekend, some call it prudent, others say bold and even beautiful, providing the middle class tax relief amounting to about $12 billion, all in an effort to boost the economy, boost consumption. This is an economy that grew more than 8% at one time, now about 6%. It is risking derailing Modi's plan to have India a developed nation by 2047. Now, a lot is being said about how the economy needs a boost and that budget may just provide that. The question really is, how much of a boost will it provide? Well, let's get perspective insights from Shweta Rajani, head of mutual funds at Anand Rathi Wealth. Shweta, good to have you with us. This is a brand new studio. We're really excited to have you here as our first guest. First off, though, this budget was released at a time of macro environment uncertainty. And we just heard from Trump himself imposing tariffs on the likes of Canada, China, as well as Mexico. How do you see that playing out for India?
Sure. Good morning and congratulations on the news studio. So yes, we did have the budget at a time when there is global uncertainty as well as, little struggles on the domestic front as well. But actually, if you see specifically on the tariffs, now what we are seeing is on a relative basis, India could actually be a beneficiary of it because there's huge tariffs coming in on China. India has an advantage, so we could get a lot of that trade shifted from China to India. On the other hand, if there are tariffs imposed on India, that's the other risk. You see that could India be the next one over there? So from that perspective, if we see in just terms of the goods that are exported to US, rough math basically says it's less than 2% of the GDP that could get impacted. And India has an advantage also that you're looking at boosting in domestic consumption. So if I have to weigh what could be the negatives of a tariff coming in and the increase in exports because China trade moving to India partially, as well as the domestic consumption giving a boost, I don't see so much of a downside risk to the Indian GDP from a tariff coming in. Of course, could there be an interim volatility? Yes, that we have to brace for.
Volatility will always be there. 2025 is going to be a year of vol. It is interesting when you take a look at how the U.S. is imposing tariffs. India, on the other hand, has been cutting tariffs, everything from autos to textiles. How do you see this playing out? I mean, on balance, how does it look for India? How does it then, how does it affect its competitiveness?
Absolutely. So, clearly there is this drive of Make in India, and which is where they've been boosting a lot of the manufacturing, bringing in a PLI schemes, reducing the tariffs here. So there would be an impact on the balance of payment because the trade deficit would widen a little. But today, over the last few years, we've got very comfortable with our trade deficits as well. There's, forex reserves, which is there. RBI has been very active in terms of ensuring that the rupee doesn't depreciate too much. So even, after, where we are seeing the rupee being, it's still on a relative basis is well positioned compared to the other countries.
Let's talk about the rupee though. It is hovering at record lows. We've seen the dollar rising for 6 days in a row. And with the tariffs, chances are the dollar will rise again. Where does that leave the rupee?
Yes. So over a longer time period, so if I exclude this few months, which could mean that, we see far more depreciation in the rupee as compared to the long-term averages, it should hover around 2.5-3% of depreciation over the next 1.5 year. That's the projection. And yes, there have been pockets even in past where you could have seen the rupee depreciating by around 5.5-6%. But then, we also have good amount of forex reserves. RBI has been intervening. And with all those steps being taken by the government, by RBI, and where we are seeing the India positioned itself to be a stronger economy, it should get back to an average 3% of depreciation against the dollar.
So where do you see the rupee trading in 2025?
I would not be surprised even if I see a 87, 88 level in the interim, and then it going back to that trajectory of a 2.5-3% depreciation.
Okay, let's talk about the budget now. We're talking about how, it's providing relief for the middle class, $12 billion worth. Yes. Yet, at the same time, we're looking at the government putting its deficit at 4.4%, hardly moving it. I mean, how do you square that?
So actually, I'll say the budget was very, very balanced in that way. There were no big bang measures announced, but very smart. The government is also trying to revitalize the private sector. So, whatever it has to do, you see the capex targets just gone up by around 10%, but they're boosting a lot of PPP module. Consumption, on the other hand, is also likely to go up. Like you said, just to give you some numbers, 25% of the salaried individuals fall in that bracket of less than 24 lakhs, where they could get a huge tax advantage because of the rebate. So that would boost the disposable income, which means consumption going up, as well as it would have a benefit on a lot of the therefore sectors over here without compromising on too much of the infra play. Infrastructure, over the last few years, if you see, there's been a moderate 8 to 10% increase across how the infra is being played. So they're not missing out on infra, while it may look like there's not much increase in the capex. It's just more structural in terms of saying private, you have to now start kicking in.
Okay, so given that backdrop, how do you play? How does your portfolio, how should it look like?
Sure. In terms of sectoral allocations?
Yes, that's right.
Okay. Clearly, first is consumption. So, given the disposable income going up, a lot of policies announced in terms of footwear, toy, all those sectors. So, consumption. Second, I would say auto. Auto again, because it will be a beneficiary of the disposable income going in. Plus, there were a lot of policies or custom duty cuts, exemptions announced for auto components, PLI schemes. So, that's going to benefit that segment. Agri, there's a 17% increase in the budgetary allocation, and a lot of those schemes announced there, which could boost, your fertilizers, seed, all of those. Banking is not to be missed over here because there's a lot announced for MSME and credit enhancement for the struggling housing sector, infra bonds. So there are a lot of those benefits. So I think if I have to just top 3-4 sectors that should be there in our portfolio, I would say this is how it should look.
Shweta, thank you so much for joining us this morning. Shweta Rajani, Head of Mutual Funds at Anand Rathi Wealth. Sherry, heading back to you. And of course, again, we're coming to you live from our new studio here in Mumbai.
Yeah, we'll be watching for the market opens in India, but right now we're seeing that downside pressure across Asia. We are seeing the Nikkei losing ground and the Kospi seeing its worst day since September of last year. Same for Kia Motors, that of course is exposed to a factory in Mexico. Kia is losing ground by the most since September as well. Other car makers are in focus, especially across Japan as well, as Nissan, the likes of Mazda, fall the most in about 6 months as well, given their exposure to Mexico. We are seeing the Japanese stock market lose ground for the first time in 4 sessions as well. We continue to watch those semiconductors, the likes of SK Hynix, Samsung, which is exposed to sales to China, also down. We have more ahead on the Asia trade. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Take a look at some of the stocks that we'll be watching when the markets reopen in Hong Kong and Taiwan after the Lunar New Year holidays. We're watching TSMC, Hon Hai Precision in Taiwan, as well as SMIC and Hua Hong in Hong Kong. Of course, those markets reopening after the holidays, and they are now going to react to last week's AI shakeup triggered by China's DeepSeek as well. Not to mention, of course, the tariffs coming from President Trump. I mean, he has talked about taxing chips as well. Morgan Stanley now saying that Taiwan and Korea are the most exposed in terms of total revenue share from exports to the U.S. as well, Heidi.
Yeah, Taiwan, TSMC really in focus today. But take a look at what we're seeing. Really red and risk off across the board from US futures to, of course, a pretty big reaction when it comes to European assets as well. Euro futures plunging by 3% and 1 point was sort of off those session lows, but still that reaction being seen across a plethora of currencies, the pound, the euro, as well as that sort of China and risk proxy in the Aussie dollar as well. And certainly the euro has been in that downward trend already, right, given the stronger dollar. It fell every day in last week's session, as well as that sort of euro area data and the economic growth prospects and bets on the ECB having a lot more cutting to do as well. And now the definitely will happen situation when it comes to tariffs on the EU are at play.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
In case you missed it, from Bloomberg's coverage at Davos.
The issue of ending the war in Ukraine must be, I believe, the victory for Trump and not for Putin. Putin is nobody for him. America is way stronger and Europe is way stronger. China is way stronger than Russia. They are all players.
We are exploring ways for Argentina to be able to open up to international trade. And why? Because the division of labor brings prosperity. Adam Smith said so. And 250 years later, that holds true. Adam Smith is still right.
I would like taxes to be lower on people and on businesses, but I'm not going to play fast and loose with the public finances, because in the end you actually don't result in anyone being better off, because it sends interest rates soaring.
I think everybody has welcomed the ceasefire in Gaza, but it's only first step. We hope that it will be a starting point for solving genuinely the Palestinian problem.
Nobody covers Davos like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Good morning. We're half an hour from the opening bell in Hong Kong with mainland China still on the Lunar New Year break. You're watching The China Show. I'm David Ingles with Rebecca Chung-Wilkins. It's only Monday, and here we go.
We're ready. We're ready for the week. Our top stories today. Asian stocks and U.S. futures fall while the dollar and oil surge after President Trump carries out his threat of tariffs on China, Canada, and Mexico.
Investors are bracing for a trade war with cars, clothing, food, and liquor in the fire firing line. China vows countermeasures while Canada unveils retaliatory tariffs, and Mexico is said to announce its response later today.
And Chinese stocks in Hong Kong are facing pressure when trading reopens today, with online retailers, chip makers, and green energy stocks vulnerable to those tariffs.
And we're live in Mumbai as investors digest India's spending plan, including $12 billion in tax cuts to boost economic growth. Good morning from the Asia Pacific. That's the only good thing really about what's taking place right now. We've been forced out of bed. My brain is still half asleep, so bear with us for the next few minutes or so. As we get warmed up today, these markets are really giving us something to wake up with, really. As my lack of caffeine is indicative really of where I am here. A50 futures are coming online in Singapore, down 2.7%. So going into the reopen of Hong Kong today, brace for substantial losses. Although I should also mention that we are coming off a little bit as far as U.S. futures go, down about 100 points. Asia Pacific, all things equal, 2.3% to the downside. All right, flip the boards. And the market that is in focus at this very minute is Taiwan. It's reopening after being shut for a week. And the TAIEX index is up by about 4%. TSMC in line with the drop in ADRs last week, down about 6%. So two things are happening: the broad risk aversion plus the market's repricing, of course, on the deep sea conversation, which by the way seems like a universe ago, given all the news on the weekend. Treasury markets 2, 5, 10, and 30. Yields on the short end are pushing to the upside, on the long end are slightly to the downside right now. And the story across FX markets is really one of risk aversion. Dollar is up against everything else except the Japanese currency. Well, the Japanese currency is now weaker right now. I take that back. 0.4%. Dollar China extremely close to that record low on the offshore rate, to be more specific. And of course, the other currencies in focus, including, by the way, and at some point, I would imagine we'll be talking about the euro very, very soon, with the U.S. president now also saying that tariffs on Europe are on the table, definitely.
Yeah, that's right, Dave. And as you say, really the agenda for today all focused on the impact of more markets when it comes to tariffs. We really are trying to weigh and see precisely what it's going to be. The surprise something is that we haven't seen carve-outs particularly. So this is perhaps a broader based measure than we were expecting. Other than that, still the currency, as you mentioned, the offshore yuan under pressure there. The level that we're watching is whether it goes above USD CNH 7.3749. If we see that higher, that will be a record low for the offshore yuan. We potentially could see some kind of intervention in the Hong Kong market via the PBOC. Onshore markets, of course, still shut today. And you were sort of hinting at this earlier, but we're trying to reconcile these two different things going on. On the one hand, we had this incredible development when it came to deep sea, upending US stocks last week. At the same time, Chinese stocks haven't been able to react to that positive news. But of course, we also have now this tariff headwind too. And then a bit of data, flurry of data, in fact, that we're expecting to come out. Tyson, China PMI numbers are going to come out. We think there may be a negative surprise there, contradictory signal according to Bloomberg Economics, as well as some retail and GDP data coming through from Hong Kong.
Yep, so it's going to be extremely busy as we make our way, of course, into the open today. We're looking at futures right now pointing to the downside, so, the Chinese markets might not even need to react to the AI conversation, given, of course, the tariff developments out on the weekend. Let's have more on the story right now and what it means for, the U.S. and its biggest trading partners. Bloomberg Economics had put out this note, in fact, if you just want to sort of justify and sort of quantify, rather, what this might actually look like. So it impacts nearly half of U.S. imports if you take the 2023 numbers in focus. It may knock off that amount from GDP. It could add that amount to core PCE. It already considers any sort of offset and retaliatory measures coming through out of its trading partners. And I think the headline says it all. A significant supply shock to the U.S. economy is what we're seeing here. Right?
I would just add, there's a couple of interesting points here. That 1.2, that model depends on whether or not those countries react in kind.
That's right.
And so Canada, yes, perhaps. Mexico, yes, perhaps. China, probably we're not going to see that dollar for dollar reaction there. So there's a little bit of a caveat. And I just did a little bit of back of the envelope maths here. But when we're thinking about now where average tariffs lie for the US, BE estimate is that this is taking it up from 3% to 10.7% for the US average tariff. Now compare that to China, now 7.3.
Wow.
I don't know if it's the first time where we've seen that big differential, but it certainly is a big shift here, just to put those big kind of dynamics in play.
So for a moment there, I was thinking, okay, are you flipping those two countries around? And the Chinese response has been one that's political, that they needed to come out. Yeah. And interestingly enough, they're taking this to the WTO, which I guess to your point earlier on, might actually be the first time since China entered the WTO 2 decades ago that this, the tables have actually flipped. We did hear, by the way, from President Trump. He spoke a few minutes ago about his plans on tariffs on the European Union. Here's what he had to say as well.
It will definitely happen with the European Union, I can tell you that, because they've really taken advantage of us. And, we have over a $300 billion deficit. I wouldn't say there's a timeline, but it's going to be pretty soon.
Let's get the very latest from our global economics correspondent, Enda Curran in Washington. Enda, thank you for joining us. Just tell us some of the details of these tariffs, Canada, Mexico, versus what we're seeing happening to China.
Yep, good morning, Rebecca. They are far-reaching in their breadth. They push well beyond the scale of what we saw back in, if you want to call it, Trade War 1.0. The 25% tariffs on both Mexico and Canada will cover food, agricultural produce, clothing, obviously autos and auto parts, lumber, and of course energy. Now on the Canadian side, there was a little bit of reprieve in terms of the tariff coming in at 10% on oil imports from Canada. Now on the China side of things, the tariff is at a lower level. It's at 10%, but it's universal. It's on everything coming in from China, and the president has targeted the de minimis threshold of $800 below being tariff-free. This has been a talking point for many years, and he's taking a look at that now. So taking it all together, economists are saying that raises question marks about the impact on inflation. If you're having tariffs at that level on consumer goods, it may flow through to households. They're questioning the impact it will have on growth. Depends how business confidence and business sentiment responds in terms of their investment decisions. And of course, then you get into the world of retaliation from all trading partners and how that plays out in all economies as well. So it's early days in this dispute. We don't yet know how all of this will play out and impact. But right here, right now, it's pretty serious signals from the White House, and lots of question marks over how this will impact all economies.
Yeah, and we're taking this almost hour to hour, day to day. So we've heard from clearly the White House. We've heard from Justin Trudeau. What are we expecting to hear from Mexico today?
Well, Mexico are playing, it seems like they're playing something of a more careful hand in terms of how they respond to President Trump. They've certainly been very clear and vociferous that they don't accept the charges around that they're not doing enough to control the flow of fentanyl, and they've made the case that they're willing to come and talk to the president and see where they can do what needs to be done to make a deal with him. But at the same time, they have promised to retaliate, and those measures will be coming, or at least will be announced on Monday morning. Canada has already put in place the first phase, at least, of their kind of dollar for dollar tariff response that they're advocating, and that's targeting key states around the US where there are key Republican senators, for example. So they're getting straight into their response. And this is the interesting part of it, is that the executive order that came out over the weekend includes a clause that the US will retaliate against any retaliation. So by all accounts, it's setting it up for something of a very protracted dispute between these trading partners. And remember, this is over fentanyl and illegal immigration. It hasn't yet, of course, gone on to thorny negotiations over the merchandise trade deficit between these three nations that President Trump speaks about all the time. And there are other subplots within this over, for example, NATO spending on the Canadian side. So by all accounts, I think it looks like we're at the early stages of what's going to be a fairly protracted process, I think.
Global economics correspondent Enda Curran in Washington there for us. Let's now bring in our chief North Asia correspondent, Stephen Engel. Tell us, Stephen, what is Beijing saying so far? Relatively restrained reaction.
Yeah, and I agree with Enda. Obviously, this is going to be a protracted process, so Beijing has to process exactly what's going to be the end result of tariffs. Is it going to go up to 60%? It's 10% right now, and there's going to be an economic impact of that. And I think right now, especially as they're coming out of the long Lunar New Year holiday, kind of crafting their message, obviously. We did hear from the Commerce Ministry expressing their strong dissatisfaction. Not a terribly strong word, strong dissatisfaction. My wife tells me that all the time about my daily chores, right? But, again, they could get a lot, more vociferous on this front. They also vowed corresponding countermeasures without elaborating, again. And again, they said they're going to take this complaint to the WTO. But again, how much efficacy is in that move when the Trump administration is said to be acting fairly unilaterally in that? They could also play with the yuan fixing. We've been talking about the offshore possibly hitting that record low. That could help cushion the blow for its exporters, obviously. But more likely, since they can't compete tariffs like for like because the imbalance of trade, you could see potentially more export controls on critical minerals. You could see market access restrictions on some American companies. And again, there could be some specific tariffs of their own. But again, how much tit for tat spiral do you want to go that would hurt China's own recovery? No doubt.
And as far as the fentanyl, China being the source of some of the precursors, how might they be able to respond to that?
Well, that's what we're waiting for, to see how far they can pledge to go to combat a problem they've never publicly acknowledged that they are allegedly causing, right? So yes, Joe Biden and Xi Jinping in San Francisco on the sidelines of APEC did talk about, combating this issue. Xi Jinping made certain pledges to combat it, but without, again, necessarily acknowledging that the chemical companies in China are producing the precursors and potentially allegedly sending them to, among others, the drug cartels in Mexico. He has near absolute control, Xi Jinping does. He could potentially do something, but does he want to do it in this frame as far as responding to a unilateral move of tariffs on China? Probably not at this point. I still think Beijing is going to take a much more measured approach. One way that the United States, and Enda mentioned it, is about this de minimis $800 package that both Biden administration and Trump administration are looking about abolishing. That's essentially, you can go duty-free and inspection-free packages direct from China to the United States of $800 or less. Yeah. This has helped Alibaba, it's helped Temu, it's helped Shine do direct-to-consumer. But what the Trump administration is also saying is it's allowed, potentially, the precursors to be sent in small packages, but in mass quantities to the United States without inspection. So that is something that review is going to be completed by April 1st. That could be an avenue that the Trump administration will take to cut off that precursors if it is indeed happening.
Okay, Stephen Engel, our chief North Asia correspondent. Just about, 60 minutes of the opening bell. We're off 3% here on Chinese futures. And just on Steve's last point, right, we have the perfect guest coming up in about 20 minutes or so. Goldman Sachs head of Chinese internet is coming on to talk us through what tariffs mean actually for e-commerce as well. A big focus, of course, particularly given all the news flow we've seen. There's also the other angle of DeepSeek and what that means for that group of stocks. So stay tuned for that interview with the head of Asia Internet Research at Goldman Sachs.
But first, the US dollar is surging in early Asian trading. Standard Chartered Bank joins us next as we track the impact of the Trump tariffs on the currency markets. And we are counting down to the open of trade in Hong Kong. You're looking at these live pictures from the Hong Kong exchange for the first trading session of that year of the snake. We'll see whether there is much to look forward to as markets have the first opportunity to digest all of this Trump news. This is the China Show.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
Right, welcome back. So we're looking ahead to the Hong Kong reopen today. Mainland markets are still shut. It's probably a good time to be shut, really looking at the price action out there. We're off by about 3% on A50 futures. It's really about tariffs. It's really about markets pricing this risk back in a very big way this Monday. The dollar is up substantially as we speak. So as we came into the office this morning, it was almost picked the currency that's really off by the most. And yeah, by most accounts, it's really everything else.
You know, we came in just trying to digest this news about Canada, Mexico. Of course, we saw big changes in the dollar there and the various currency exchanges. But then no sooner had we sort of started to make sense of that, we had this news that EU tariffs could be coming very soon. We have quite robust language from President Trump on the tarmac saying that, you know, he's really unhappy with the trade deficit and so on, and the openness to trade and US exports not going into the EU and so on. And so I wonder if today also we shift this focus to also be thinking a bit more about what happens with the what happens with the euro, rather.
Yeah, absolutely. He could not be more definitive as far as that was concerned. In fact, the phrasing there on the tarmac was concerned. And on top of that, too, Mexico has said it will respond Monday. So we're keeping an eye. We're really on headline risk as far as FX markets go. On the dollar note, we're up 1%. Let's bring in Stephen Englander, Global Head of G10 FX Research at Standard Chartered, joining us right now from New York. Stephen, a pleasure to have you on the show, and sorry to bug you on a Sunday. The news gods are raining heavily on us today. Why don't we get started with the dollar? What's your sense of how much further the dollar can strengthen short term here?
Well, let me say, it hasn't been much of a Sunday for me either, or a Saturday. Look, I think the market's still digesting what's happening here. I think that there was a sense, especially after last week with the on and off Colombia tax, that Trump wanted to use them as a negotiating ploy. But he seems to be like a poker player who's betting his whole stash on the first hand, not sort of feeling out the table to see what's going. And it's, the market just wasn't prepared for it. He's sort of really hammering Canada and Mexico, their two biggest trading partners, doing some damage to China. And I think it was clear the only reason he didn't include Europe was he couldn't find a national security argument for including Europe. But he'll find some other reason to add tariffs on Europe. So I think the market's seeing this as full-scale risk off and much worse than what was anticipated.
Stephen, I want to ask also, how does this exchange rate differential between the currency, between the US dollar, how much reprieve does that offer China when it comes to these 10% tariffs?
Well, it offers it some, right? When at the beginning, say when the Trump odds started going up at the beginning of October, dollar CNH was around 7. Now it's 7.5. So, the 5% depreciation there off a 10% tariff of, on some goods. So it does give them some help. The other advantage, say, that China has is that it has, diversified trading partners, unlike Mexico and unlike Canada. So, and they've been diversifying for a couple of years now. So in some ways, they're in a better position than the other countries that Trump is kind of tariffing up.
Stephen, yields are pushing higher. Is the market pricing in the inflationary impact here? And how does this affect the Fed's easing cycle? I believe you still have one cut penciled in for March, if I'm not mistaken, Stephen.
Yeah, look, I think there's a lot of fear here, but let's talk about what the market is doing, and then we can talk about what we're thinking. What the market is thinking is that if he's doing tariffs, it's because he wants the revenues to enable tax cuts. And so the market sees not just more inflation or higher price level from the tariffs that translates into short-term inflation, but it's also seeing fiscal stimulus down the road. So it says, okay, which way are yields going? And, they're going up, and, the yield curve is steepening as a consequence. We think the economy might hit a pothole, and that cuts are still on, but obviously, both we and the Fed have to factor in the new developments.
Yeah, Stephen, the risk that, and we're obviously taking this almost headline to headline, minute to minute, what about the risk that Trump's team reverse course in this? Is that something we should be thinking about if some of the economic sort of benefits aren't pulled as quickly forward as they had once hoped?
I'll tell you that's a pretty fat tail. I mean, a lot of this dollar strength is U.S. exceptionalism. If it turns out that this doesn't work, that tariffs are very disruptive, that exceptionalism story goes down the drain, and we're just in a world kind of where everybody has a bit of stagflation. That's not what equity markets are priced for, and that's not what anything is priced for at this stage.
Stephen, again, thank you so much for joining us on your Sunday. Stephen Englander there, Global Head of G10 FX Research at Standard Chartered Bank. Just under 8 minutes, 7 minutes, in fact, to the opening bell, reopen here in Hong Kong. And yeah, I mean, if you're long these markets, one thing to do, close your eyes. This is the China Show.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, we can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage, and what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back. Just under 5 minutes of the open, reopen. Okay, it's getting interesting. So here's the thing. So you had this deep risk aversion taking place across these markets, no pun intended, on what's coming next. Although, as you can see, we're not actually doing as badly compared to the rest of other markets right now. And this might actually be down to this offset that we're seeing across some of the deep-seek related plays here.
Yeah, really interesting. I mean, obviously markets were not open to try and, let that news sort of provide any kind of bump up. It was highly disruptive for US equities. So perhaps not a surprise that we are now seeing some of this deep-seek, the advancements that we saw in their new release model coming in. Of course, the first major open source AI model of its kind that really sort of threw and seemed to throw so many US AI providers kind of off their beat a little bit.
Yeah, a wrench and the horse's carriage, as they say, into that. It wasn't also DeepSeek, or only DeepSeek. So Alibaba also came out with their cloud unit, actually came out on Lunar New Year's Eve with their own version of that. As you can see, up 5% as far as that is concerned. So we'll continue to track that. In fact, in a couple of minutes, Goldman Sachs head of Chinese internet will be coming on to take us through this. Very quick glance at some of your semis, and yep, it's playing out as far as these guys are concerned. Hong Kong listed energy shares, big pop in energy prices. Globally, we're getting the opposite effect there, and the risk aversion in your markets globally this Monday, we will look at that. 3 minutes to the opening bell. Sort of usher in and sneak into the ear of the snake. And it's interesting given the juxtaposition we're seeing across global markets, and somewhat, we've been reminded of this time and time again, somewhat of an uncorrelated asset. Chinese assets and markets have been and sort of served for your portfolios, and that's playing out to some extent, right? So you have this tariff news really poleaxing risk assets, including Hong Kong. Not as badly, though, because there is a deep-seek offset that's playing out as far as the Alibaba is concerned. A couple of markets that have come online this hour. You have Singapore, Malaysia. We're off there. The Philippines was actually down 4% on Friday, so that's actually seeing a little bit of upside right now. That market entered a bear market, keep in mind, on Friday. On your screens, just to mention that too, is Bonnie Chan, of course, who is the boss at the Hong Kong exchanges. Let's have a look at currency markets. Yeah, there we go. Dollar Canada, high since 2003. I believe it's also overbought when you look at some of these momentum and technical indicators, but I guess is today a day where you start looking at that? Maybe not. Dollar Japan, 0.4 of 1%. And the open here in Hong Kong, can I get it up please if we can? So Hang Seng Index actually was trading at about a 3-month-ish high going into the long weekend. So we're down, not bad actually. This seems like a normal day, but the night is young, right? 0.9 of 1% on the HS Tech Index. To the point we were making earlier on, Rebecca, right? There you go. Alibaba, bottom of your screens, is up 3-4%, and this is down to the deep sea conversation that rattled U.S. markets last week. Yeah, absolutely. And I think maybe something of a surprise, given how much the tariff conversation has really dominated, particularly on the FX currency story that we've seen so far. Just to help us understand what we're seeing when it comes to deep-seek, artificial intelligence, the internet space in China, let's bring in Ronald Kung, Head of Asia Internet Research at Goldman Sachs. Ronald, I mean, let's kick off with what we're seeing, a little bit of this offset, it appears, at least maybe for the Hang Seng Index. Alibaba still up around 4%, I see. To what extent have we already seen sort of the benefits of the deep-seek advancements playing out? How much more upside do we have?
Sure, thanks, Rebecca. I think over the past week, basically, we had multiple models. So it's not just DeepSeek, it's actually multiple models. 5 of those, at least big ones, have announced by Chinese players. And of course, investors have been talking about, is it a US model versus Chinese model? It's actually more, there's a debate, is it open source versus closed source? And I think for AI, the key to kind of obstacles in proliferation of that over the past year is cost, and is it smart enough? And over the past week, we've seen these models that have improved themselves through reasoning, through actually going through the reasoning process, how they think before they speak. I can say human beings, we think before we speak. And in the past...
Well, hopefully. yeah. Not for all of them.
That's what we strive for on the show.
And over the past year, we've seen chatbots just give you the answer split seconds. Now they think and tell you what is the thinking. So that's really the strength of being smarter, then they get better results from these AI models. And the other is cost. Have they thought about how to make the cost lower? And Chinese players, we think, due to some of the limitations in computing powers, we've seen them focusing not just on the performance, but also on cost. As these AI models get smarter and the cost comes down, we think this year, US team and our team in Open Research, we expect proliferation of AI applications and agents. And this is how from virtual pets to chatbots to applications that helps you in studying, all of those, as the cost comes down per token, we think the proliferation year is 2025, the proliferation.
Just to follow up that point, so if it's not a story about US versus China, but instead a story about kind of innovation, really expensive innovation on the one hand, and kind of more low cost, perhaps we can call it best practice models on the other, is that kind of bifurcation, I mean, to what extent does geopolitics still play into that, I suppose? Because we still have this big question mark of chips access. So I guess if it's not US versus China, where does the geopolitics come in?
So we see 5 overarching themes for China Internet, but for theme 2, the growth of AI agents, applications, but at the same time, theme 3, which we highlight, is geopolitics. And so you still have the balance between could the Chinese players get the computing power, the chips, at the same time this will impact their capex, which is theme 5, the balance between AI capex and shareholder returns. And so I think the overall is how do these companies balance the innovation while open source helping to develop different models. As I said, 5 models will launch, a few of those are open sourced, and this open source means many people will learn from these open source, and the open source community with developers develop more, and so helping each other in open source means driving better and smarter models, and then at the same time driving lower costs.
And you mentioned the conversations that you guys are having with your U.S. colleagues, and does it seem like the containment efforts from the U.S. side are having not a political answer, but having the intended effect on the runway that we're seeing for a lot of these Chinese players? Because you mentioned it's not just DeepSeek, right? We've had a number of models come out. It's almost a reminder that they haven't worked. That's an open question, I guess.
It's evolving as we see geopolitics as the key theme, one of the key 5 overarching themes for China Internet. And I think for that front, we've seen a lot of the Chinese apps have come on board into the top downloads. Just over the past month, we've seen TikTok, we've seen RedNote, we've seen all of these companies moving up into the top downloads. I think it's just the innovation and how these companies in China has been building on efficiencies. We've seen the cost optimization over the past year or two, driving better profitability on cost controls, and I think the innovation still continues no matter it's from, we say, super apps in China. I think this is one of the innovations that across the world, the super app in China has payment, has instant communications, short videos, now transactions as well. And so in the key theme, one of the overarching themes is how these super apps are moving more and more into transactions as well. And as they go into the SKU levels of data, then your instant messaging, your short form videos in WeChat, that drives also transactions, and that brings on competition. Therefore, we see competition, AI, geopolitics, and domestic policy stimulus. These 4 are the key swing factors for our China Internet sector.
Do those factors address the monetization concerns? Do you think at some point will the technology be a massive revenue generator?
I think on monetization, first is the existing businesses. So this year we expect a lot of our platforms to support SMEs.
Okay.
And they will have very strong profit growth in 2024 for across our platforms. And for this year, we expect a more flattening of what we call a GMV margin or profit margin on the domestic businesses. But yes, on cloud and hyperscalers, our businesses have built a cloud business across computing. And so at hyperscalers, we do think they will benefit from a proliferation of AI applications. But at the same time, of course, AI applications are moving partly more on hyperscalers, but also on edge on your phones.
Yeah.
And so this is the fine balance as the whole AI moves from training to inference, how these applications drive demand from both big data centers, but also more computing on your phones.
Just from a follow-up on some of the tech consumer names, there is this concern that tariffs are going to weigh, particularly when it comes to removal of this de minimis exemption, essentially allowing sort of duty-free goods packages that are valued at less than $800. That's a pretty hefty chunk of exports that are coming from companies like Temu and Shein and so on. How much of a hit does a 10% tariff, the removal of a de minimis, how much of a hit is that to some of these Chinese companies?
Yeah, so we've written very extensively across kind of tariffs and de minimis. I think the key is does it apply to everyone? And the essence of online models is a direct shipping from manufacturers to end consumers, just fewer layers. And that's how Amazon, that's how e-commerce businesses in China. And therefore, if it's applicable across everyone, then the cost base moves up, but it doesn't impact a single player. And we have to still continue to monitor the developments, as we call this, is the geopolitical overarching themes, a lot of evolving things that happens across tariffs, across apps and operations in the US, data security, all of those. So this is still a highly evolving situation.
I think we're moving into earnings season here in Greater China in a couple of weeks. Just what are the top themes, apart from this, that you're tracking there?
Yeah, so I think the fourth quarter, December quarter, will start to kick off the result season from late Feb, and then the core key companies reporting across March.
Yeah.
We expect a pretty solid December quarter. There's also some of the better than expected consumption trends in December. Versus November, there was actually a big pickup in appliance sales, and then communications like mobile phones also has some pickup. I think it's partly on the Chinese New Year that we've just been through. I think a bit of consumption that was front-loaded a bit in the last week of December, but also the domestic consumption policy stimulus. That's why what we're preferring this year, at least for the time being, with all of these noise and geopolitical situation, is we prefer domestic consumption stimulus-focused position in China internet, plus some more defensive like games. I think that's how we like our preference. And heading into the result season, we also expect domestic policy stimulus leverage company in appliances, in electronics. Those retailers will benefit more with a more solid December setup and into 2025.
Yeah, we've been forced into work this early in the year. Everything from AI, tariffs, and soon enough earnings. Ronald, thank you so much for coming in. Ronald Kung there, head of Asia Internet Research at Goldman Sachs. On Chinese tech, laid it out quite nicely there, the themes to watch. From one Goldman note to another, so just to mention here as well, the good folks at Goldman Sachs put out this on the economic side of things, and back to the tariff impact, right? Just they're thinking of how initially we might see this play out from a policy implication perspective. So if the 10% tariff increase, if it stays, and their base case is still 20%, so it's still lower than that, it would reduce growth by that much, put downward pressure, modest downward pressure, I think on inflation, and flip the page, please. The next page actually tells you everything as well. But it might mean that the PBOC will need to emphasize and prioritize FX stability ahead or instead of monetary policy.
Right, this whole question of whether or not it limits the amount of room that the PBOC has to move here when it comes to the Chinese economy.
Yeah, there we go. Okay, how many stories have we gone through today so far? I'm counting 1.5 million right now. TSMC, that's the other angle. It's everything that's going on right now. So Taiwan markets are just coming back online after being shut for a week. We're off by 4% on the benchmark. We're coming off a little bit right now on the stock itself, down about 6%. Let's bring in Winnie Su, our Asia equities reporter, who's been tracking this actually for us from last week into this reopen we're seeing today. And yeah, Winnie, are we surprised that it's doing as badly or not as badly as we think, or as we thought?
I would say probably not as badly as we think. Like you mentioned, it dropped about over 6% at the open when the market came back from the Lunar New Year holiday, and that was almost the most since the August meltdown. But it has kind of come back up a little bit. Yes, we're facing the kind of the aftershock of DeepSeek that Taiwanese market was able to avoid last week, and just like we saw last week on Friday, SK Hynix was actually down 10% when South Korea market reopened. So it's not that surprising that we're seeing some sell-off in the TSMC shares. And also just to note, like we're seeing with the tariff risks right now, although it hasn't really mentioned semiconductors yet, just the tariffs around China, around Mexico and Canada. We saw in one of the notes from Morgan Stanley saying that they are still quite cautious around that area, expecting some more tariffs to come. So with both the tariffs and also the news around DeepSeek, it is not a big surprise that TSMC is under pressure and hence pressuring the Taiwanese market that pretty much relies on TSMC for 40% of the moves in the stock market.
And Winnie, when it comes to the Hong Kong reopen, is there anything that stands out to you or has taken you by surprise at all?
Yeah, so actually we just saw the Chinese shares in Hong Kong opened just now, and it was down about 1%. So yes, it's down, and people were expecting that stocks would go lower because of the tariffs on China. However, it actually still outperformed the overall weakness in the region, and people are saying that because the 10% tariffs, it's not really something new. We've heard about it already, and just a milder tone from the Chinese authorities. And with the tariffs coming in, potentially we are going to be able to expect some more stimulus from the Chinese government ahead of around March with the two sessions. So that is giving some hopes for investors, and also with the advancement in some of the Chinese technology shares, with Alibaba talking about its AI investment. That's also helping Chinese shares a little bit compared to what we saw in the Taiwanese and in the Korean tech shares.
Okay, Bloomberg's Asia equities reporter Winnie Su there from Tokyo. There is plenty more ahead. Stay with us. This is Bloomberg.